Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner, and founder of Menninger Associates Financial Planning. I'm here also with Kyle Ryan, also a certified financial planner, CFP, as well as a chartered financial consultant, and also one of the equity owners of my firm, and now the longest tenured individual at my firm as well.
So, and the
Kyle,
longest title I've ever had.
That's right.
Thanks for having me.
Thanks a lot. So what we're going to talk about is kind of a brief overview of the OBBBA, which is the One Big Beautiful Bill Act.
Yes.
Which I can't believe they actually officially called it that. But we're going to talk about some of the overview of what it is. I mean, there's a lot of pieces that go deep into the businesses and deductions and bonus depreciation. We're really not going to get into that because while we get involved in that, that's a lot more towards the accountant side. What we get involved in is a lot more of the daily financial planning for individuals. Now, mind you, business owners are individuals. They just happen to have the ability to do things with their business that can impact their tax return. But we're just going to look at most of the basic things.
Yeah, and how we're incorporating into our planning as we approach the end of the year, certain things that you as a viewer can think of in your own financial planning if you're not working with someone like ourselves.
Right. And so what happened was this got done on July 4th, and I was pleased because basically what happened is when President Trump put the previous TCJA, Tax Cuts and Jobs Act, in force was in 2018. And it was scheduled to expire, or as they call it, sunset, December 31st of 2025. Well, interestingly enough, the prior tax code was supposed to expire on December 31st of 2010.
Yep.
And they decided to extend it, but they didn't extend it until December 28th. Okay. And I think, we were talking this morning in our staff meeting, look at how much, we're approaching December 1st. We're still slammed, and we're probably going to be slammed well into the month of December. And we started early this year to make it easier. Okay, it's really working out well. But could you imagine if we didn't know the results of the tax code until December 28th?
Until now, and you're scrambling to change all the assumptions you made throughout the year. Even this being past halfway through the year, they made it retroactive to cover all of 2025 for certain things. So certain planning that you had already done had to be readjusted.
Yeah, but it wasn't that bad. In fact, in every single case, it in no case did it hurt anybody. In every single case, it potentially helped people.
Yes.
Okay. So the premise of the bill was basically the tax laws as we know it under President Trump from 2018 were set to expire. And what they did is they extended them. I love the word permanently. It's permanent until they change it.
Even in our notes here, permanent has the air quotes next to it, the quotations.
That's correct. So really permanent, it's just kind of funny. It's just that it doesn't have a sunset date. The practicality, in my professional opinion, is we could probably assume that the tax code is going to last at least through 2029.
Yes. Yeah. Usually you're not going to have a president come in. The first thing that they're doing is aiming to increase taxes or address the tax code.
Right. That's correct. It takes them a year to get their feet wet because full well it doesn't matter. That President Trump is not the next president. So whether it becomes a Republican or a Democratic president, it kind of still doesn't matter. They're going to need a year before they do anything with the tax code.
And it's going to be fun discussions because I'm sure Social Security is going to be in the air at the time.
Oh, yeah.
So a lot of things going on once they're, readdressing these permanently extended tax codes.
Right. Exactly. Well, I've always said, I've been teaching taxes since 2003, that these tax laws are just the cheapest we've ever been in, and it can only go up because we're building up these massive deficits and how much we owe is just $35 trillion.
Yeah.
It just keeps growing.
And as we often say, we're currently in the lowest tax bracket system we've been in since World War II, roughly,
How about ever since we've had taxes? Okay.
For us to be approaching the sunset of this, for taxes to increase, for it to be permanently extended, really opens the door for planning opportunities for these next 5-6 years while we have these current tax brackets. And it also shed some light on a lot of the planning we were doing to get ahead of the sunsetting with tax brackets increasing next year. We just have a little bit more runway in terms of what we were doing.
Right. Because we thought once President Trump was reelected, we thought there was a chance that he would actually attempt to extend the tax laws.
Yes.
So normally where Q4 is when you're doing the aggressive tax planning, what it did is it gave us the ability to sit back and say, you know what? They might not change the tax laws. I mean, we were looking at doing a lot of things to get it under the wire under the old tax laws, which turn out to be the continuation. So what did they basically do? Some basic things that they did. Number one is they extended the tax rates.
Yes.
Okay. They gave a small increase to the standard deduction above what the increase was from the prior year. The prior year, the standard deduction for a married couple was $29,200. They brought it to $30,000, which was a standard growth.
Yes.
With this, they increased it even more.
And basically, it's $750 per person. So if you're a single tax filer, you get to deduct an additional $750. If you're married filing jointly, now it's an extra $1,500.
Right. There you go. So
if you're taking the standard deduction, that is.
So now, all during President Trump's campaign, he promised three things: no tax on Social Security, no tax on tips, no tax on overtime. We'll talk a little bit about the tips and the overtime, but I felt that there was no way he was going to be able to pull off the no tax on Social Security.
That was a big nugget to bite off for.
Right. So what they ended up doing is they added an enhanced senior deduction, which we'll also talk about. One of the bigger ones that came through was SALT, and SALT stands for state and local tax deduction. They made sweeping changes to that, which was good. I mean, the Democrats were big on that one.
Yeah, it was part of the compromise.
That's correct. That's correct. And they made slight adjustments to QBI, did they?
Yeah. So they did make, slight extensions. QBI, qualified business income deduction, refers to a business owner under a small, of a certain company size being able to deduct part of their profits outside of their tax return.
So basically they extended it, and that was one that they thought was going to go away as well.
Exactly.
So it was a standalone.
Yep.
It was a standalone that while they extended the tax cuts, they also extended the QBI.
Yep.
And then they made adjustments to the child tax credit. There's going to be new rules associated with charitable contribution deductions in 2026. We'll talk about it. And then they made adjustments to the estate tax exemption.
Yeah.
So what we'll do is we'll take a little bit of time to go through each one of these individually.
Yeah.
All right. So we first started talking about the standard deduction. That was easy. Okay. I mean, all we did was for our tax planning, it gave everybody an extra little bit.
Yeah, there's not really per se planning behind that, unless you're thinking of versus itemized deductions, which we're going to cover in a moment anyway.
So the one that did come into play, that did have an impact on planning, is the enhanced senior deduction.
Yes.
If you were over age 65, or at least attained age 65 by the end of 2025, in other words, being born by what, 1950? 1960.
Yes.
Holy cow, the 1960 people are 65 already. It's scary. Okay, 1960. Basically, if you were born in 1960 or before, you get an extra $6,000 standard deduction, or $12,000 if you're married, but it came with
phase out.
A phase out.
Yeah. So if your income is over certain amounts, you start to lose that deduction. So for married individuals, that phase out is roughly $150,000 of what's called MAGI. Well, we call it here MAGI. It's modified adjusted gross income. So $150,000 to $250,000. If you're over 250, you get none of that enhanced senior credit. So realistically, what it looks like is basically a 6% deduction. Because $6,000 over the course of a $100,000 phase out, it's a $6,000 deduction. You lose 6% for every $1,000 you go over it. There's some real planning opportunities within there if you are within that phase in range.
Right.
For single filers, that same phase out is from $75,000 to $150,000.
Right. Yeah. So it goes by 75?
Yep.
Okay.
Yep.
So basically it hurt us in a couple places, because That is something we never predicted at the beginning of the year.
And you mentioned that, right? So when I mentioned earlier in the episode that we were doing planning, let's say in January, we're targeting doing Roth IRA conversions to the top of the 24% bracket. You're a married individual. We do a Roth conversion of $200,000. We've been doing it for years as part of the plan. What could go wrong? What could they change retroactively? Well, now because of the planning there, we don't get the enhanced senior deduction, which adds another complexity as it relates to Roth IRA conversion planning. Because when you look at someone's effective or marginal tax bracket, this is really going to impact what we project it to be. Whether you get this deduction or not, if we completely go through it in the form of Roth IRA conversions, something to consider.
It's no different than it was at the beginning of the year because they wouldn't have gotten it anyway.
Yeah.
So in some cases, we did the planning at the beginning of the year, not even projecting that was going to happen.
How could you?
And then there are other cases when, to your point, we were trying to bring Maggie to under 206.
Yes.
Which is for IRMA. And IRMA is income-related monthly adjustment amount, meaning that your Medicare premiums won't go up if you stay underneath that threshold, so which we were doing a lot of.
Okay.
So for a married couple, we would bring their income to 200. Lo and behold, what happens? They just lost a little bit of their enhanced senior deduction. So we'll take that into consideration. But one of the things to also take into consideration is that what we realized is that phase out, to Kyle's point, it's actually 12% for married because it's $12,000 that goes away over the $100,000 period from 150 to 250. But be careful of the 12%. What it is that puts someone in the 22% tax bracket. So it really means their marginal rate is 22% plus 12% of 22%, which is like, 2.4.
It's not a huge increase.
No, but it's some.
Yeah, it's something to consider.
It takes it from 22 to 24.
Every percent matters.
Exactly. I mean, you try to plan for that, and unfortunately, we didn't know that was coming. Yeah. But you try to make plans for it. But in many cases, we just blew through it anyway.
Yeah. And to your earlier point, it still holds true that a lot of the changes that came out of this bill were really impactful from a favorable perspective for a lot of the people who are taking Social Security. In lieu of getting that free Social Security, they're getting a lot of deductions that would otherwise reduce the taxation of that income.
Yeah, we found actually that a lot of people that we were doing planning for to run them to a 0% tax, we actually had $12,000 more income that we could do. So it gave us the ability to take more income and do a lot of things with different people. But once again, it's a planning thing.
Yep.
And, you get $6,000 per individual. And again, for single, it's $75,000. It was when it begins to phase out. And for married, it's double that with $150,000. Yeah. So it's just things to take into consideration.
It really just further emphasizes the point that tax planning isn't just this stagnant thing, that you do the same thing each and every year because the rules, the laws, everything changes around you. Your taxable income changes. So what you do on a year-to-year basis really matters. If we have clients who are retiring this year, that we were going to do massive Roth IRA conversions up to the top of the 24% bracket, even beyond the 24% bracket, a lot of these things are now changing because now we have the permanent extension of the current tax brackets for another 5 years. Maybe we don't have to do as much in Roth IRA conversions. So there's always things that you need to consider each and every single year as things changes. So you can't just have a stagnant tax plan.
Exactly.
Yeah.
The one other thing that I thought, tell you what, is the SALT. But I tell you what, we're actually at a good breaking point. So what we'll do is we'll come back and we'll talk about the second major impact, which is probably the largest impact, I would imagine. We'll talk about that in just a few moments when we return. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we're going to pick up where we left off on the next big issue associated with the tax law changes that were actually impactful. What they did is SALT. SALT stands for state and local tax. Historically, And I remember when the tax laws came out, or at least the proposed tax laws in May of 2017. And I remember looking at it and I was like, you know what? If this tax thing goes through, hardly anybody is going to be itemizing. Lo and behold, it went through and hardly anybody's itemizing, at least certainly for married couples. So basically what happened was they had capped your ability to take itemized deductions for taxes to 10 grand. You say, well, 10 grand seems like a lot. No, it is not. If a person in a household makes, let's say, $250,000, it's not an egregious giant number. Okay. It might be higher than this, top 10%, but we see it a lot more these days. But you figure in Pennsylvania, they're paying a 3% state tax and a 4% local tax. I'm sorry, 1%, which is a total of 4. 4% of 250 grand is 10 grand. All right, they're there already. Then they own a home and they got property taxes.
Yep.
Well, guess what? Now they have property taxes, which are 6-8 grand. Okay. And next thing you know, all of a sudden, and by the way, you go to high tax states, and this is why it was an issue, because you got high tax states, California, New York, New Jersey, basically the Northeast and California. They're like, well, geez, you know what? My property tax is $15,000. I'm paying state tax of another $10,000, and I'm capped at 10. That's ridiculous.
Yep.
So that was a big fight, and it was actually a fight for, I believe, the one side. The Democrats were pushing for get that in there to offset because they were complaining and something.
Yeah,
great.
and the way it was offset at the time in 2018 is they just massively increased the standard deduction.
That's
they
correct.
got rid of the exemption. So, you got away with the SALT deduction, but you really increased your standard. So not everyone, it
That's correct.
impacts too many people outside of the
It's just the people in those higher income states got whacked. So they did that, and it actually works out nicely, although it does phase out based upon your adjusted gross income. So if your adjusted gross income is under $500,000, you get to take as much as you want. If it's over 600, you lose it. The other example that I forgot was a lot of people in our area own Jersey Shore homes.
Yep.
So they got their primary residence, which is $6,000 or $7,000 or $8,000, but then they got the New Jersey Shore residence, which is $10,000 or $12,000 because
you can't even throw on top of it.
Right.
Yep.
And now they can.
Yep.
So what's happening is that a lot of people now, particularly in those high tax states, are going to be itemizing again.
Yep.
And they'll be happy. It's not going to make that much of a difference.
And that's the thing too, is planning wise, we're trying to get people's income. If you're above that, we're trying to get you lower so you can get that state deduction, that SALT deduction,
Right.
because chances are if your income's that high, so is your tax bracket. And that means that deduction is that much more valuable for you.
That is correct.
So
there's
a lot of planning opportunities there.
That is correct. But it's just, again, it's knowing the rules of the game. Because if you have the ability to be taken, let's say someone's making $600,000, if you have the ability for them to make some form of an adjustment at work to drop their income down, okay, like creating a cash balance pension plan for their staff to lower their income to get into the SALT. Hey, you know what? There are things that you might consider doing. Or in our case, we were debating, do we do Roth IRA conversions above a certain dollar amount?
Yep.
Or do we decide that we're going to take capital gains or not take capital gains? Well, this is a reason why you don't.
Yep.
So it just adds a layer of planning into planning.
Imagine that.
Yeah.
And on another one of the deductions, because when it comes to itemizing deductions, you've got like really major 4 big hitters. State and local taxes are one of them. The other one that was changed with the One Big Beautiful Bill was charitable deductions going into 2026. Those are going to have some pretty big impacts, because one of the things that you saw once the Tax Cut and Job Act came out, it became less financially incentivized for people to give to charity. It became harder to itemize those deductions to make it increase to the amount of the standard deduction. So they've once again addressed that. Going into 2026, if you are a standard deduction taker, there you go, as opposed to an itemized filer, you take the standard deduction, you're allowed to take an above the line deduction for contributions to charity next year.
Up to $1,000 per person.
Up to $1,000 per person. So if you're single, you can take $1,000 above the line deduction. If you're married, you get to take up to $2,000. That's the really only concrete change for people who take the standard deduction as it pertains to giving to charity. For those who are itemizers, this is something that's really going to take a big impact for us, for people who are worth a decent amount, have high income, and are giving a lot of money to charity. Next year, with itemized deductions for charitable contributions, they made quite a few changes. For one, you can only itemize your charitable contributions up to starting at above 0.5% of your adjusted gross income. All right. So let's say you make $200,000. $200,000, 0.5% of that is $1,000. You can only write off or itemize any charitable contributions you give that are above $1,000.
Correct.
Right. So if you give 10, you write off 9. So what's happening is a lot of our clients have donor advised funds. We call them DAFs, where we're contributing hundreds of thousands of dollars to charity. Well, all of a sudden, if your income is to the tune of $400,000, you're donating, hundreds of thousands of dollars. It doesn't have that big of an impact on you because, you're reducing a nominal percentage of how much you can write off. But it is something that is a consideration of the floor of AGI that you're able to write off against.
Well, what you might find too is people who may or be close or not close may choose to front load.
Yep.
And we're doing that with folks that we just met last week. What we're doing is they want to just got a giant increase. They wanted to make contributions. They're arranging with their church to contribute $7,000 a year to the church. I said, wait a minute. I said, given how the tax laws are going to change next year and that you're going to lose some of it, given that it's going to get eaten up by your standard deduction, I said, would your church mind if you did it this year? He goes, no.
Getting money sooner.
Really, exactly. So we're giving the church extra $7,000 next year's charitable contribution. We're going to give in December. Part of that is driven in their case, they're not exceeding the standard deduction.
Exactly.
But on top of it, then next year, they can still give up to $2,000 and be able to deduct it.
Yep.
And then pushing all of it into this year because you had a boon year because you received a big bonus. Suddenly, this is helping us
itemize
for this year. So
it all worked out.
The other thing that it's going to do, it's going to impact the uber wealthy. Okay, is the second thing that happens is, let's say somebody makes $1 million. That means 1% means, or 0.5%. 0.5% means their first $5,000 is not deductible.
Yep.
The second thing is that those people making $1 million are probably in the highest tax bracket, which is 37%. What they've also done is they've said that if your itemized deductions are associated with charitable contributions, you're capped to a 35% tax rate for those deductions.
As opposed to the current 37.
Correct. It's not a lot, but it's some.
It adds up.
You know what?
Absolutely.
Every bit does add up. I mean, we're cheap with other people's money, particularly when it comes to the IRS digging into their pockets.
Yep.
So if we could find ways to help clients maximize tax efficiency, hey, all the better. So want to talk about the QBI? I mean, the QBI is the qualified business income deduction.
Yep.
That was something that was added in 2018 with the tax laws. They did extend it. It was separate. They did extend it, but I think they also raised the phase out.
So there's an increased phase out. So depending on if you are a specified service, trade, or business, and what they call an SSTB. So basically, as a financial advisor, as an accountant, as an attorney, certain professions have their income. Once you reach a certain point, you can no longer deduct that QBI deduction. And they increase the phase outs marginally. Those phase out numbers I don't have in front of me. But for people who are non-SSTB, which is the majority of businesses out there, it is so important to be working with your tax advisor to understand how you can maximize this benefit. Because the deduction that you can take here isn't just so much that it's 20% profit, because we have people with businesses that are shooting out profit of $1.3 million, hundreds of thousands of dollars that are eligible for the QBI deduction if they can set up either their W-2 wages correctly. There's certain things that you have to do to qualify for those deductions. That's why it's really important from maximizing QBI, working with your tax advisor, because it's very specific to your business as to how you can qualify for that.
And there's a lot of really nifty, cool things you can do with your income. Okay, to your point where they added that new as a percentage of your W-2 income, you want to coordinate the two. But one of the things that I learned early on is that you have the ability to shift your income from W-2 to, if you're an S corp, the ability to have it be a profit, which could save a lot of taxes there as well.
And that's where, if you are above the taxation range for FICA taxes for Social Security.
Right.
So if you're already above that, the benefit of K1 versus W-2 income, it's still more beneficial to have K1 in most circumstances.
But not as much.
But by increasing your W-2, if you can increase your QBI deduction, that's where you start having some fun with planning and saving money on taxes, just by shifting around the salaries.
Right. It's just a function of understanding it. And, work with your accountant. The problem is you're going to need to do some of this planning in advance. And, like I always say to people, tax planning is not done on April 15th. That's when you're turning in your scorecard, which is a 1040. If you wanted to shift money from W-2 to K1 or K1 to W-2, or profit to W-2 or W-2 to profit, you can't wait until April 15th. Because your W-2 income is generated before December 31st.
Yep.
So we encourage, and that's why our Q4 is always so darn busy, because we're planning ahead.
Yeah.
Okay, so if you're doing any type of tax planning, you want to plan ahead. Talk to your tax advisor or talk to your financial advisor if they're tax savvy. So just recommendations that we make, because it's not how much you make, it's how much you keep.
Yep. And the last change that we want to just make a quick note on it short is from an estate planning federal exemption limit. So the federal government will tax your estate up to 40% of whatever you're worth above a certain amount. Now, this year in 2024, it's $13.99 million per person. Next year, pre the One Big Beautiful Bill, it was supposed to get reverted back down to an inflation-adjusted $5 million, probably would have been closer to $7 million. That got extended, so that next year it's going to be $15 million. That impacts planning because some folks out there were funding irrevocable trusts, getting the money out of their estate to grandfather themselves in ahead of that lowering limit. So thankfully that planning has been passed down the line a little bit, but is always on our minds. They drop that exemption limit, there's going to be a ton of estate planning conversations going on.
That is correct.
Yeah.
That is correct. And last but not least, we touched on it very briefly, is, again, one of President Trump's promises on his campaign trail was eliminating taxation of Social Security, which he failed miserably. Not miserably, but
tried. He did so. I guess he did so.
And then no tax on tips and no tax on overtime. And, it's like, oh, great, because we were ready. Immediately my head's spinning. All right, I'm going to pay all you guys
overtime.
$10 a week, and the rest of it is overtime, right? This way you can escape. Well, it don't work out that way. Yeah. So it depends on the type of business, I believe, that you're in.
Yeah. The majority of your income has to be based on taxes, tips or overtime income.
Right.
Yep.
And then lastly is you're capped at, what is it, 25,000 married? Yeah, 25,000 married and 12,500 if you're single to reduce. But hey, you know what? If I can reduce my income by 12,500 or 25,000, that helps. Now, I will say this much. Okay, I'm glad you're sitting down. Shocking. The IRS made rules, or Congress made rules. A little on the vague side.
Oh, no. Oh, really?
Yeah, shocking. So actually, I've been having discussions with accountants. I'm like, how exactly does this work for someone who's considered self-employed? And they said, well, it's not clear.
It almost sounds like it depends.
Right. Well, it's not clear.
Yeah.
And so, this happens with a lot of laws that the lawmakers in Congress make. They hand it off to the IRS and they don't know how to implement it.
Yep.
And it's just, anyway, so there's still some ambiguity with that. And I still run into ambiguity with a lot of tax laws that exist on the books.
Is that a big surprise for you?
Shocking. But at the end of the day, if I have an accountant doing my taxes and my accountant says, we believe at our firm that you can take this deduction, you know what my response is?
Okay, you're my first line of defense.
Take it.
Yep, go for it.
All right, cool. So that's basically, there are a lot of things that go deep into the weeds as far as what OBBBA did as it pertains to the businesses deductions. But, generally speaking, we're focused more on the individuals as well as the business owners because they are individuals. And these were the main hitters. Once again, we didn't talk about the child tax credit went up from $2,000 to $2,200, which is great. So basically the major hitters were they extended the tax laws, the extremely low tax laws. They added the enhanced senior deduction. They added the SALT or lifted the limit on SALT.
Yep.
Added a little bit of child tax credit.
A little bit on the standard.
Yeah, and the QBI.
Yep.
Okay. In my opinion, I didn't think the tax law changes were that much. They gave a little bit more, but they gave a little bit more to an extremely tax-friendly environment already. So, and they're saying that it's going to cost $3.4 trillion. That's one of the things that we've talked with Brad about. The Office of Budget or whatever it is with the government, they always do the estimate as to how much this is going to cost us in taxes. But what they don't estimate is how much more revenue could it generate in tax revenue because it impacts businesses in a favorable manner. They don't do that.
Spur the economy, ideally.
Right. So anyway, all right, that's all we got for today. So I hope you learned something. I hope you can at least take advantage of this and utilize it for your own personal uses. Take it to your accountant, or if you have any questions, you ever want to reach us, encourage our phone number here is 610-422-3773, or our website address is www.maaplanning.com. That's MAA as in Menninger Associates. Again, www.maaplanning.com, 610-422-3773. We hope you have an absolutely wonderful day and week. Thank you for joining us.